how the borrowing works and what you have to be aware of and the things that you have to be to know. So basically, first of all, you have to have a self-managed super fund set up. So we all understand like what's a corporate trustee and a self-managed super fund, right? Then, if you're having funds in retail fund or anywhere, if you don't know where the money, your super fund, it's always good to go to the ATO website and like file your super. So some like they have like 1.7 trillion or something that people didn't actually claim for. So it's worth like if you work in your lifetime, it's worth to go there and file out like if you have any loss.
What's the size? mysuper.com?
You go to the www.ato.gov.au and then you can type like find my super and it will bring you to the link.
Oh, okay.
Yeah. So you have all your supers and all that, you consolidate, roll over everything into your own self-managed super fund. That's the starting. So you set start, you put that money in there, and then every year the employer or yourself, self-employed, can contribute the money into your self-managed super fund. Right? We talked about that. And what happened is now you go and look for property. So you've got everything, documents, and I'll talk about the documents a little bit like when I go to the next slide. So you go and look for the property, then you found the property that you like, and they say, oh, say that property was about 400,000 and you want to buy. Then what you have to do, you have to go and set up a nominee corporate trustee. So you have to use this nominee corporate trustee to hold this property. So a lot of people make a mistake that they go and use the self-managed fund as a title in that property. That's incorrect. If you want to use the self-managed funds to borrow to buy property, you must go and set up a nominee corporate trustee to hold that property. Okay, and then you have to have this bare trust. All things has to set up before you purchase the property. So at the day or before the day of purchase, you have to get the document correctly done. Bare trust. What the bare trust means is like they're just holding the property on behalf of the self-managed fund. Okay, the bare trust doesn't have to launch a tax return, doesn't have to apply for tax file number, no APN, nothing. It's just holding on behalf of the self-managed fund. Then you can go to the bank and borrow money, or you can lend it. It works exactly the same. Like if you have a lot of equity outside and you want to lend the money to the super fund, and rather than go to the bank, you can do it. It's exactly the same process. Or you can go to the bank and then you can go and borrow the money, and normally they lend it up to 80% now. Like if you want to buy a property for 400,000, you can borrow it up to 320,000. Up to the value of the property, not the purchase price, because sometimes you pay more. And you have to look for the magic words. You have to be careful with like in the loan document, it has to mention this word called limited recourse loan. Do you know what that means? Okay, yeah? Okay, what it means is like, for example, if you buy this property for 400,000 and say this property, and then you go and borrow 320,000 from the bank. And what happened, so it's only worth 200,000 now. Anyway, it's only go down to 200,000. So if you can't repay the loan, and then the bank have to force to sell that property for 200,000, even though you owe the bank 320,000, you can walk away from that. You don't have to pay them back the 120,000. And that's what the limited recourse loan means. Do you understand? But it's different if you personally go and borrow the money, like say in your name, and it's not limited recourse loan, and you borrow 320,000, and then you sell your property for 200,000, you pay off the bank, and you still owe 120,000, right? The bank still chase you. You still have to pay that back if it's under your name. You know, like if it's not unlimited. But if it's in a super, that's all they can get. So that's why when you want to use the self-managed funds to borrow, because we do mortgages as well. I have St. George, very popular, St. George, Westpac, Macquarie, Westpac's all, yeah.
They'll only be 70%, won't they?
St. George is 72%, Macquarie is 80%. And yeah, Macquarie can get up to 80%, and really? St. George is 72%. Yes. Yeah. Come to me. It's going to be more, about probably 1% more because of this risk. Yeah. But it's still better. Look at the tax that, you know, when people say, oh, I have to pay 6%, but whereas if I borrow in my name, it's only 5.2%. So it's still less than the tax. It's only 1% more. So what? It's okay. All the rent that you receive from this house goes to the self-managed fund. So this bank trust doesn't have to go and open up up a bank account, doesn't have to apply for tax file number, doesn't need to launch a tax return. Everything goes to the self-management fund, the rent goes there, any expense come out from the self-management fund. So if you need somebody to repairs and maintenance this house, the invoice has to be in the name of the self-management fund. And when you purchase, the title of the property has to be into this nominee corporate trustee's name. You have to get it right. And the document have to date it before you purchase the property. It's very, I'll go through the 20 things with you. And then the self-management fund will make the loan repayment. And how to make the loan repayment is that you got the money from 9% contribution, or if you can make 25,000 would be good, plus the rent, that money can pay the loan to the bank. And after you pay off the loan, the property can transfer, the property here can transfer back to the self-management fund. And you have to get the document right to avoid double stamp duty. Because some of the lawyer or condensing lawyer, they don't know how to get the paperwork done properly. You might end up paying double stamp duty because they thought that that property belongs here. How does it relating to here? But how it relating to here is by this document to say that this is holding on behalf of self-management fund. Get it? So this security document has to get it right. And otherwise, 20 years later, they go to the Office State Revenue and they want to transfer the title back to here. They say you have to pay another stamp duty and capital gains tax. So you have to do the paperwork right. So there's 3 things you must be aware. 3 things. First, avoid paying double stamp duty. You have to get the right person to do this for you. Because if they don't know what they're doing, you might end up paying double stamp duty. Make sure that you comply with the SIS Act. So first you have to check your trust deed up to date. You have the investment strategy in place. And then you can go and do this. Because if you order a check and you don't have that, you are non-compliant. And the tax can get taxed up to 46.5%. Or beware of the capital gains. 20 things you need to know. I'm going to quickly go through this. I know it's a lot, but I just want you to be aware. You don't need to remember, but you just be sort of know. Okay? 20 things that you must know if you want to enter in this sort of transaction. First thing is that make sure the trust deed is permit you to do it, gives you the permission to do it. The trust deed, upgrade the trust deed. Make sure your bare trust trustee, you set up the corporate, the nominee corporate trustee. Get it right? You have to do these 20 things, okay? It's just like a checklist. Tick, 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 and then you'll be fine. Just a checklist. So you make sure you've got the nominee corporate trustee, you've got the bare trust, the self-management fund must be existence as at the day of purchase. As at the day of purchase. I always put the same day at the day of the exchange. And you have to have the investment strategy we're talking about, and then you have to consider the risk, the return, the liquidity, the normal stuff, the cash flow. I was talking on a break about, oh yeah, if you want to go in there, do I have to have money? Yeah, you have to make sure your cash flow can afford it. It's just like any other investment that if you want to invest outside, you still have to work it out with okay, what if you don't have rent coming in? What if I stop work? What if I got no money in? Can I afford to repay that? You still have to do that due diligence. It's the same, it's cash flow, it's numbers game. Work out on your numbers. And then the bare trust documents, have to get it right. And also you have to consider how you're going to borrow the money. Are you going to borrow from the bank or are you going to borrow from yourself? Which way is, because if you borrow from yourself, right, you can get interest rate cheaper. Because if you get your house to go and secure, and you borrow like a normal home loan, you pay 5.2%, and you can lend that to the super fund, and the super fund doesn't have to, like, you can have a bit of saving there. Get it? So you can lend to the super fund, or you can borrow from the bank. And the term of the finance, you have to be careful, and you have to watch this magic word, that it has to be a limited recourse loan. That's what I mentioned. The other thing I was going to say, the number 9 is like, if you already have existing self-management fund loan, and you pay a very high interest rate, you can refinance that. That's okay to find a cheaper interest rate. It's just like a normal loan, you can refinance it. And only one bare trust for one property. This is very important. When you set up a document, the nominee corporate trustee, you can use that as many times as you want, but the bare trust document, it can only one single asset, one bare trust for one property. So if you want to buy the second one, you have to draft up the second bare trust to hold the second property. Very important. The tax office actually got ruling coming out for this, and you have to get that right. And the bank trust does not need the tax file number. I'll repeat it again. And you cannot obtain, okay, you can't use it, say if you want to buy a block of land and you say later on I'm going to develop, you can't. But if you want to go and buy a house and land package and the builder is willing to do it in one contract, so for example, some builder, they will let you, like, you can buy land and house land package, but you settle at one go. You don't have to buy the land first and then you build a house. Like 2 contract, no. But 1 contract, yes. And you can, if you need to borrow money to do the repair of the property, you can, but you can't sort of knock down all the whole house and then build a new one, improvement, you can't do that. Every state is different, so just watch out the stamp duties and all that. All rent, income and expense is going to be paid from the Seller's Fund bank account. Legal title of the property has to be held in the nominee corporate trustee's name, not the self-managed super fund's name. And there's no CGT. If you do everything correctly, there's no capital gains tax, no stamp duty when you transfer that property to the self-managed fund. If you did it incorrectly, they will treat it as a 2 separate. It's just like I'm selling to one, I have to pay the capital gains and I have to pay the stamp duty. So you have to make sure the document get it that right. You don't have to pay off the loan and you sell the property. Say, for example, you bought it for 400,000 and then maybe in 5 years it's gone up to 800,000 and you want to sell it, you can. Just sell it just like a normal. You sell the 800, pay off the loan, whatever the cash left over, it sits in your self-managed fund account. And you don't have to wait till you pay off the loan, then you sell, you don't have to. It's just like a normal property transactions. Every invoice, like repairs, I mentioned that, must be in the self-managed fund's name. And you have to comply with the CSAT. That's all. It's not complicated, but you just have to get it right. I'm just going to summarize it now, because we talk about 5 steps, right? I'm up to the step number 3, build a self-managed fund. The step number 4 is we're going to grow it. And this is going to be repeating, like you have the investment strategy, you do the insurance review, like make sure you've got life insurance and everything inside your super fund. And then every year you get it invest, you can invest in anything, property, shares, and overseas property or international management fund, whatever that you want, okay? And then you do the accounting. Every year you have to go to the accountant, do the accounting, financial accounts, lodge the tax return, and then it repeats like a cycle until you retire. And then the tax that you pay is 15%, capital gains is 10%. When you build up this nest egg, you've got 1.5 million in there, and then it's time for you to retire. Now you're going to take the money out. So step number 5 is enjoy your retirement. Now you've got the money. There's another planning, how I'm going to use my money. What's the plan? Like I want my money to last for another 35 years old. Or maybe you're thinking I want to leave it for my children. You have to plan. Now is another stage. Do you understand? Now do I want to spend it all and I don't care about my kids? It's up to them. Or do I want to keep the capital and I just want to enjoy the income, the egg? And I leave the goose, you know, the big there, and I just enjoy the golden egg. And I'm not going to touch that. I'm not going to kill it. Just let it grow, and then I pass on this to my children, and that's your legacy, and that's what you're working hard for. You know what I mean? And because your children can have that benefits, and they don't have to go through what you go through, and they don't have to work that hard. They enjoy the benefits. It's our children. So it's depending on what you want, your dreams, and so forth. You don't have to pay any tax, and then you build up your tax-free income. How cool is that? You get it? So there's 5 steps there, okay? I've talked about that. How can you access your super, which is you reach age 65 or you reach your preservation age. So I'll give you an example there. You know, if you're born after 1st July 64, then because that's the year that I'm born, and then the age is 60, and then you can enjoy your money. Thank you very much. Finish.